lock your door, rip the phone cord out of the wall. When Morgan Stanley quietly presses the nuclear button, you don't have much time left. If you can still hear birds singing or the hum of traffic outside right now, it means you haven't realized the severity of the situation. On this seemingly calm midweek morning, if you are still browsing market indices as usual, or patting yourself on the back over a tech stock's quarterly report, you are standing on the edge of a cliff without knowing it. I'm not going to mince words. This isn't about some insider trading gray area, nor is it marketing rhetoric designed to peddle a cheap course. The trembling stack of papers I have on my desk right now is a death sentence from the deep state of finance. This is a document originally destined for the shredder, a top-secret memo from the innermost sanctum of Morgan Stanley, the financial leviathan managing $2.3 trillion in global assets. Just 72 hours ago, this file slipped silently into the encrypted inboxes of the most powerful people on the planet. The recipient list is dizzying, even at a glance. Titans of top macro hedge funds, operators of sovereign wealth funds controlling national lifelines, and the invisible ultra-wealthy at the very tip of the 0.01% pyramid. And amidst those complex financial terms and legal disclaimers, Morgan Stanley used just 3 words to declare the end of an era. Hidden within this classified document are 3 words that should send a chill down the spine of every Wall Street elite. Not reduce exposure, not hedge, and not wait and see. But exit all positions. Stop, take a deep breath, and chew on the weight of those 3 words. In the linguistic system of Wall Street, filled with euphemisms like dynamic hedging, risk rebalancing, and tactical underweighting, the word exit is an extremely violent term. It is not a suggestion, it is an evacuation siren. It is the captain's final order when the Titanic's keel lets out a deafening crack. This is no longer about how to make money, but about how to survive the impending destruction. Morgan Stanley is not just warning its clients to completely abandon the silver market. They have drawn an uncrossable red line, the end of this month. This is not a drill. This is institutional panic. This is a group of the world's sharpest mathematicians and risk control experts staring at their models countless times and reaching the only possible conclusion. They are sitting on an active volcano about to erupt, and there are only days left before the lava swallows everything. I have cross-referenced and verified the authenticity of this memo through independent sources deep within the institutional trading community. What I am about to show you is likely the highest level financial intelligence you will ever encounter in your life. When a beast like Morgan Stanley wants to flee at any cost, it means they have seen something in the black box of their proprietary trading that is completely invisible to the public eye. A catastrophe capable of reshaping the global precious metals landscape is counting down, and you must choose now. Treat this as background noise, or join the escape game where only a tiny minority will survive. Smart money never waits for the rain to fall before opening an umbrella. Before the storm hits, they have already retreated to high ground. Let me break down for you exactly what Morgan Stanley saw. The logic behind it is not only chilling but watertight. More importantly, you need to know how to act before the escape route is choked by the panicked crowd. The memo itself is a masterpiece of minimalism, just 3 paragraphs, yet every word is a blade that cuts to the bone. For clients holding billions in positions, bullshit is superfluous. Paragraph 1. The technical death sentence. The memo states explicitly that, in light of extreme market volatility, and remember this phrase, structural changes in the silver derivatives market, Morgan Stanley strongly advises all institutional clients to liquidate immediately. Whether it is COMEX futures, options, or over-the-counter OTC swaps, whether long or short, clear everything to zero. Structural change is the nuclear code of the financial world. It means the rules of the game have physically collapsed. It's like an engineer telling you the main load-bearing pillar of a bridge has pulverized, and the laws of physics no longer support the bridge's existence. At that moment, you don't calculate how many cars are on the bridge. Your only move is to close it. When the market structure changes, it means the gravity that originally maintained the price discovery mechanism has failed, and the system is about to spiral out of control. Paragraph 2. Escape at any cost. Immediately following that, the bank issued the most hair-raising directive. Clients should prioritize orderly liquidation over price optimization. Translated into plain English, we don't care how much money you lose. We need you to get your body out. Forget about whether the current price is ridiculously low. Forget about how ugly this trade will make your performance look this year. As long as there is even a shred of liquidity left in the market, sell to it. The current loss is microscopic compared to the disaster coming at the end of the month. That deadline wasn't drawn arbitrarily. It is a mathematical wall they are about to hit. Morgan Stanley knows a series of irreversible chain reactions will converge at that time, and holding any position then will be tantamount to suicide. Paragraph 3. The Leviathan's self-castration. The final paragraph drops a nuclear bomb. Morgan Stanley announced it will reduce its own proprietary silver exposure to absolute zero within the same time frame and until further notice. Indefinitely suspend accepting any new silver-related business. The weight of this decision is monumental. A bank exists for only one reason: to earn commissions and spreads. Every trade, every contract is a cash cow. When a top investment bank says no to new business, or even actively severs a revenue stream, it means the risk has become so great that they are willing to sacrifice potentially billions in profit. They have calculated clearly, the money earned from the silver trading desk is not worth the risk of the silver desk dragging the entire bank into the abyss. This is no joke. You need to understand how a document like this is born. A bank doesn't decide to scare clients on a whim. Every syllable here has been scrutinized by an army of lawyers, compliance departments, and chief risk officers, and finally signed off by the highest board of directors. Telling clients to exit all positions is a massive legal gamble. If the bank is wrong and causes clients to miss out on a rally or suffer unnecessary losses, the lawsuits they face will be astronomical. Therefore, the fact that Morgan Stanley dared to put this in black and white proves only one thing: their internal risk models are screaming. They would rather bear the risk of a false warning than the certainty of death by staying in. So, what exactly has the gods of Wall Street so terrified? Morgan Stanley's commodities desk possesses a god's eye view of the market. They see not just K-line charts, but X-rays of the entire global supply chain. They monitor the dark operations of other giants, JP Morgan, Goldman Sachs, and they track the physical movement of every ounce of metal. Right now, on their dashboard, 3 red lights are flashing wildly in unison, signaling the arrival of a perfect storm. Crisis 1. The physical depletion of inventory. COMEX registered inventory is not just falling, it is in free fall. Current inventory levels have breached the 2 million ounce warning line. To the average person, this might sound like a large number, but in the ocean of global finance, it is not even a drop in the bucket. This is the lowest level seen in over a decade, but what is truly terrifying is the speed of its disappearance. Just 6 weeks ago, this figure stood at 41 million ounces. In a month and a half, 9 million ounces evaporated into thin air. An average of 1.5 million ounces of physical silver is being withdrawn every week. Simple math tells us that at this rate, registered inventory will hit zero in about 21 weeks. But markets never move in a straight line. Panic accelerates everything. In just the past 14 days, outflows surged to 4 million ounces. If this acceleration continues, the vaults will contain nothing but dust in 8 weeks or less. Skeptics will bring up the 230 million ounces in the so-called eligible category. This is the big bank's greatest lie. Eligible inventory does not belong to the exchange. It is the private property of wealthy families and hedge funds stored there. With physical premiums soaring in Shanghai and London, why would these savvy holders sell their silver to COMEX at suppressed prices? They absolutely won't. Those 230 million ounces are frozen. They are untouchable. This means the system's only real buffer, that 32 million ounces of registered inventory, is everything, and it is drying up. Crisis 2. The delivery tsunami and mathematical impossibility. To understand this, you must see through the core scam of the silver market. It is a mirage built on paper promises. Historically, behind every ounce of physical silver, there are hundreds of ounces of paper silver contracts spinning in the void. The premise that kept this game going was that 95% of players were only betting on price fluctuations and never wanted the actual bars. But now, the rules have changed. In the last delivery cycle, the percentage of contracts demanding physical delivery skyrocketed to 9%, double the historical norm. Preliminary data for the upcoming month suggests this ratio could hit 12% or even 15%. Let's do a simple arithmetic problem. There are currently about 160,000 open contracts, each representing 5,000 ounces, totaling 800 million ounces of paper claims. If 15% of these holders demand delivery, the exchange needs to cough up 120 million ounces of physical metal. However, the vault only holds 32 million ounces. A demand of 120 million, crashing into a supply of 32 million. This is a double deadlock of physics and mathematics. When this moment occurs, the exchange can only default, declare force majeure, and attempt to settle forcibly in cash. In that instant, the paper price will become worthless because everyone will realize that piece of paper can never be redeemed for real metal. Crisis 3. The collapse of the shadow market and counterparty risk. Outside the exchange, there is a massive and opaque shadow market. Estimates suggest there is between 5 to 10 billion ounces of notional exposure lurking here. The vast majority of positions are held by short sellers entities who sold silver they fundamentally do not own. As the physical price begins to break free from the gravity of the paper price, these naked short sellers are bleeding out. Through its tentacles in the interbank lending market, Morgan Stanley sees other players frantically scrambling for collateral and credit lines being maxed out. If just one major player fails to meet a margin call, the dominoes will start falling. In a highly interconnected financial web, one bank's failure is a black hole on another bank's balance sheet. Morgan Stanley sees the first domino wobbling, and they don't intend to be the ones crushed underneath it. These three crises are forming a doom loop. Inventory drop triggers panic, is greater than more people demand physical delivery, is greater than vaults deplete further, is greater than short-selling banks are cornered, is greater than frantic buying to cover positions pushes prices up, is greater than rising prices induce more physical hoarding. This cycle is self-reinforcing and accelerating exponentially. Morgan Stanley's data models show the detonation point is at the end of this month. Why the end of this month? It is not just a timing issue, it is a survival issue. The end of the month is the critical moment for banks to perform mark-to-market accounting. All positions must be valued to calculate capital adequacy ratios. If the books show massive silver positions that are about to blow up, it directly threatens the bank's credit rating and license to survive. Morgan Stanley is forcing a liquidation to perform a complete cleansing of its balance sheet. They want to be able to look regulators in the eye before the disaster strikes and say, "We have zero exposure to the silver crisis." History always rhymes. In the Hunt Brothers squeeze of 1980, the exchange temporarily changed the rules, banning buying and only allowing selling, artificially suppressing prices to save the banks. In the 2022 nickel squeeze, the London Metal Exchange literally pulled the plug, voiding billions of dollars in trades to protect short-selling insiders. Morgan Stanley knows this dirty history well. When the house is about to lose everything, the dealer flips the table. This time, they don't want to sit at the table waiting for the rules to change. They are choosing to leave with their chips early. This explains the true intent of the memo. If Morgan Stanley ran away quietly without notifying clients, they would face accusations of breach of fiduciary duty once clients were wiped out. Sending this memo serves two purposes. First, to build a legal liability shield. Look, we warned you. Second, to organize an orderly retreat. If everyone tries to sell in the final minute, the market will flash crash instantly, and even Morgan Stanley won't be able to get out. By setting a deadline, they are managing the tempo of this great escape, trying to extract their massive bulk from the burning building without triggering a total avalanche. For retail investors currently staring at their phone screens, looking at $30 silver and thinking life is good, this is an attack from a higher dimension. They don't know the giants already have one foot out the door. When the masses finally wake up, the exits will be welded shut. As the end of the month approaches, you will witness the great divergence. The prices of paper silver and physical silver will completely decouple. In order to close long positions, institutions will dump paper contracts at any cost, causing the screen price of silver to potentially crash. But in the real world, you won't be able to buy an ounce of silver coin with your paper money. Physical premiums will rocket upwards. The screen might show $30, but dealers will ask you for $50, or simply hang a sold-out sign. This is the essence of Morgan Stanley's warning. Price is about to become an illusion. Now, you stand in the fissure of history. On one side, smart money is retreating silently. On the other, mainstream media is still whitewashing the piece. You won't see this memo on CNBC because the people controlling the media are the ones who haven't finished running yet. They need you to stay in the game to provide liquidity. They need you to catch the bloody chips they are discarding. Time is running out. You need to think like a risk manager, not a gambler. Step 1. Immediately audit your risk exposure. If you hold silver ETFs, unallocated accounts, or futures contracts, you are holding air. In a structural default, these paper certificates are the first waste paper to burn. You might wake up one day to find your ETF has been forcibly cash settled at an extremely low price. Step 2. Seize the final conversion window. There are less than 3 weeks left until the end of the month. Your goal is to convert all paper assets into physical possession. Yes, buying physical now requires paying a premium, but think of it as insurance. Would you rather pay $40 to own real metal or hold on to $30 worth of paper that might go to zero? The institutional logic is better to buy expensive than to be wrong. Step 3. Watch the red line data like a hawk. Check the COMEX inventory reports daily. Once registered inventory breaks below 25 million ounces, that is a red alert, meaning default is unavoidable. Step 4. Prepare for schizophrenic volatility. Paper prices will thrash wildly like a dying beast. Short covering will bring spikes. Long liquidation will bring crashes. If you hold physical, turn off the screen and forget the quotes. In this phase, the only real price is the price at which you can buy the metal back after selling it. I know, this sounds like feverish ravings. You might think, if it's really that serious, why hasn't it collapsed yet? This is the skeptic's trap. You think because it hasn't happened, it won't happen. But look at the weekend before Lehman Brothers collapsed in 2008. Look at the overnight sudden death of Silicon Valley Bank. In this hyper-leveraged world, collapse is never gradual. It happens instantaneously. If Morgan Stanley is abandoning a profitable business line out of fear, then the mathematical probability leaves no room for suspense. Run with the smartest people in the room. Even if you run purely by mistake, you only lose a little on transaction fees. But if you stay, and they are right, you lose everything. This is a global geopolitical chess match. The East, China, India, is vacuuming up Western physical silver, while green energy and high-tech industries are consuming every ounce of output. The global structural deficit is irreversible. No matter how many paper contracts Wall Street prints, they cannot print a single gram of real silver. Morgan Stanley has read the ending. The old game of manipulation is over. The countdown has begun. Morgan Stanley has given you God time, a 72-hour head start on the general public. This is the only difference between winners and losers. The door to the exit is still ajar, but the footsteps of the crowd are getting closer. Don't wait until the stampede begins to remember. You need to find your shoes. When the last page of this month's calendar falls, the paper bridge will turn to ash. The only thing that will keep you afloat is the real thing you hold in your hands. Before it is too late, clear the illusion, embrace the reality. Act now.